Everyone is screaming about an AI bubble. You've probably heard it 100 times, AI is overhyped, it's a tech bubble, it's the next .com crash. But here's the thing, while the headlines panic, billions of dollars keep flowing into AI every month. Why? Are investors blind, or is there something happening behind the scenes that most people simply don't understand? In this video, we're going to break down the facts, the risks, and why calling AI a bubble might be far too simplistic. By the end, you'll know exactly what's going on, and why it matters for investors like you. It's easy to see why people are nervous. The AI market is dominated by a handful of companies, and much of the current hype is fueled by speculation about future capabilities rather than immediate profits. Companies like OpenAI, Nvidia, Microsoft, and other tech giants are spending billions to stay ahead of the AI arms race. The products being released don't yet generate returns that justify the astronomical valuations, and many outsiders see this as a recipe for disaster. Add geopolitical risks, rising interest rates, and questions about AI's real-world use cases, and it's no wonder everyone is shouting, "Bubble." But here's the critical nuance, just because it looks risky doesn't mean it's doomed. One of the reasons this market hasn't collapsed like previous bubbles is simple: cash. Over the last decade and a half, tech giants have quietly built enormous cash reserves. Microsoft, Apple, Meta, and Alphabet hold trillions in liquid assets, far more than most other companies in history. For years, tax laws encouraged them to keep money offshore, but reforms in 2017 allowed these funds to be repatriated to fund domestic investments. This dry powder gives tech giants the ability to invest in AI projects without relying on outside investor money. Unlike the .com or housing bubbles, which were propped up by debt or continuous inflows of small investors, the AI market's foundation is far more solid. These companies are using their own money, strategically investing in projects that could pay off massively in the long term. Critics often point out what looks like circular investing. Nvidia funds OpenAI, OpenAI spends with Microsoft, and the money keeps moving in a loop. On the surface, this can seem unsustainable, even reckless. But when you look closer, there's a strategic logic here. By investing across the AI supply chain, these companies maximize the chances that they'll capture value from every innovation. Unlike a Ponzi scheme, this isn't about taking investor money and collapsing, it's about reinvesting strategically to grow the entire ecosystem. Yes, it's complex, and yes, mistakes could be costly, but it's also far from irrational. When we talk about bubbles, history looms large. The .com crash in 2000, or the 2008 housing crisis, were catastrophic, but they had very different foundations. .com startups relied on endless investor capital to survive, while subprime mortgages were built on complex, fragile debt structures. AI investments, by contrast, come from companies with decades of market dominance and huge cash reserves. The risk isn't that the market will collapse overnight, it's that these bets might not deliver the enormous returns expected. Investors may see temporary setbacks, but the likelihood of a total implosion like 2000 or 2008 is far lower. Despite the strong foundations, the AI market isn't without risks. Share prices are elevated based on future expectations, and if AI doesn't generate the anticipated revenue, those valuations could correct quickly. Regulatory changes, geopolitical instability, and technical bottlenecks could all disrupt growth. Yet, the biggest risk isn't failure, it's perception. Investors betting billions are making calculated, strategic decisions. Most of them aren't gambling recklessly, they're positioning themselves for long-term domination in a technology that could redefine global markets. So what does this mean for everyday investors? Understanding the structure of the AI market helps you separate hype from substance. Knowing that big tech companies are using their own cash strategically rather than relying on small investors or debt gives you a better framework for evaluating AI stocks. It also shows that risk is nuanced. AI isn't a guaranteed win, but it isn't a guaranteed disaster either. This perspective allows you to make smarter decisions about exposure, portfolio allocation, and long-term strategy. The AI market is complex, high-stakes, and full of hype, but understanding how the money flows gives you an edge few people have. If you want to keep decoding markets, investments, and how money really works, hit that subscribe button, like this video, and turn on notifications. The more you learn now, the smarter your financial decisions will be tomorrow. Don't just watch the hype, understand it.